Today is Monday, June 19th. This is a recap for the stock market activities last week and an outlook for the week to come. Now folks, I got a good one for you tonight. Happy Father's Day, happy Juneteenth, and let's start with this. We continue to monitor the stock market bubble, which we're supposed to believe that it is different this time around. Oh, the old bubbles, they were made in China. The new one, the Chinese market is not even participating this time around. This one is the real deal. Made in the USA, baby. Okay, but we are now at the IPO mania stage. And this week we got a new IPO, finally. And it is for a stock called Cava. CAVA, and it is a Mediterranean eatery, which is now valued as a tech company. And perhaps this is due to Cava's AI falafel sandwiches, which can now predict exactly when the diarrhea is going to hit. It burns! Maybe this one is the real deal. Maybe this one, this time it's different, right? Maybe Cava is going to join the ranks of other successful IPOs, where the retail mom-and-pops investors got rewarded, of course, such as Coinbase, Revvion, and Snowflake. But it's not just here, folks. We see it all over the place. You see it in the German DAX, you see it in European equities, you see it in Japanese equities, you see it in Indonesian equities. All of a sudden, the Indonesian market is up 1,000% with no explanation at all. And of course, some would say that last year was a bad year, and we have a lot of short positionings that do to be covered, and therefore we see these unexplained rallies all over the world. But not really, at least not here. When we look at the short interest in the Qs and the SPY, that's actually way down now, at the lows in at least a year, which of course suggests that the rally is due to a stampede. There are people stampeding to buy. And of course, as dumb money buys, smart money sells. The insiders, they say thank you so much, they dump, they buy, and hello retirement. Off to the private jets to Costa Rica and spend the money on blowing hookers. Now we got an NVIDIA board member dumping $48 million worth of shares. You got another board member since 1993 unloading $76 million worth of shares. These are some hardcore believers in AI, wouldn't you say? And of course the mentions of a new bull market, quote unquote, all-time highs. This has to be a generational buying opportunity. You know, when the rest of the herd believes that it's a bull market, when everybody thinks it's a bull market, I believe it's a good time to buy. I think Warren Buffett was quoted once saying, buy when everybody's euphoric. But then you got the Debbie Downers, like the Maverick Wall Street and Wells Fargo now, who now says the recession is at our doorstep. Should we call the police or something? But investors are falling for a Goldilocks scenario. Wells Fargo says, it isn't going to end all that well. What do they know, right? I mean, the NASDAQ is up over 40% from the bottom. And these people are talking about a recession is coming. When it's a bull market, we've never seen a rally worth 40% plus and then the market tanks, except of course in 2000. And you really have to watch the bond market, because there is a saying that goes, the bond market never lies. The bond market is always right. Well, we now have a divergence, a big one, a historic one, between the bonds and the stock market. Who's lying here? Is it the bond market that never lied before? Or is it the stock market? Somebody's lying. Somebody has to be right. Either the bond market is going to catch up, or we have a fugazi rally on hand and it's not going to last. Most importantly, of course, we have to look, when we talk about the bond market, that is, we have to look at the 10 to 3 month inversion, 10-year, 3-month inversion. And this is the steepest inversion in decades. And every time this happened, it was succeeded by a recession. Most importantly, the last time we have seen this phenomenon in this century, we've seen it back in 07 and 2001. In the 07 case, 2 years after the initial inversion, the stock market went down by about 40%. In the 2001 case, the stock market went down by 28.6%. Now the question becomes, do we follow the trend from this century and we'll be down 2 years from now by double digits, or is it going to be the exception? Of course, this disconnect that's going on right now, Goldman Sachs blames on the expectations of inflation. Goldman says that the market's implied inflation outlook is out of whack. It's not really in touch with reality. And if it moves higher to become closer to touch with reality, then things will change in the market. And the problem is, if Goldman Sachs is right, and we have sticky inflation for a long time, then this means rates will stay higher for a long time. And the problem with that is we have more and more maturities coming. When we talk about the next shoe to drop after regional banks, we know we have a lot of junk bonds, a lot of zombie companies, and these maturities are getting shorter and shorter and shorter, and the rates are going higher and higher and higher. When you look at the commercial real estate sector, for example, we have trillions of dollars worth of debt about to be refinanced starting this year at much higher rates. So So here we are again talking about systemic risk after regional banks. And the source of this risk is higher rates by the Fed. We see the reflection of that in the fixed income and commercial lending markets. And the bottom line here is the rosy picture that's being painted right now, it is dependent on lower yields, which means lower interest rates by the Fed. In other words, rate cuts. And rate cuts are dependent on inflation. If inflation sticks, no rate cuts, higher for longer until something blows up. And that's not really a recipe for a safe bull market. And the reason is real bull markets start after the disaster happens, not before. And the disaster is yet to come. You're seeing it right here, right in front of you, with higher rates and more maturities and refinancing coming. We're talking about trillions and trillions of dollars in this economy. You look at overseas, in the UK, for example, you have all of these homes now have to be refinanced. The mortgages have to be rewritten again at higher rates. What do you think this will do to that economy? But right now, in 22, when we talk about the market dynamics, we know that we have three things moving markets: fundamentals, technicals, and mechanics. In 22, it was a fundamental market. This was the number one driver of the stock market, followed by technicals and then mechanics. And when we start talking about the fundamentals and the Fed policy and inflation, it doesn't look so good for the market. And we see reactions just like we saw back in 22. The market that we have today is led by the mechanics, followed by the technicals, and then the fundamentals in the backseat. And the question now becomes, are we about to see the technicals taking back the leadership of this market and pushing mechanics down? We'll look at the S&P's chart since the October bottom. Look at the RSI. It was way oversold. And the moment that coincided with a tame CPI readings, the fundamentals took the backseat, allowing the technicals to take over. We saw the technicals taking over. We got an oversold rally. And then in the month of February, as we started to get higher inflation readings, and then soon enough we got the collapse of SVB, the market became a fundamental market once again. This is not a favorable outcome, and therefore the stock market went down. And then part of the reassessment of what happened to SVB is the outlook that this will push the Fed to pivot, and of course, we might have seen some increase in liquidity by the Fed. So we see a recovery and then a period of consolidation and thinking. And as we get NVIDIA's earnings and the S&P passes 4,200, we now see what it's known as a mechanical market, which is led by options. These kind of markets can be really impulsive, defy all the odds, but they end short. And the reason is options have an expiration date, and they end violently. We usually see the climax followed by a sharp pullback. Why did we see the mechanical market to begin with? The answer is, once we got NVIDIA's earnings, once we got S&P 4,200, a lot of folks waiting on the sidelines said, okay, I know what's wrong with this market. I know maybe I'm making a mistake here in buying and chasing, so I'm going to do it via call options. I'm not going to commit the capital. I'll just buy call options, and if they hit, they hit. And if by expiration we get good news and the macroeconomics improve, maybe I'll exercise these options and own these underlying stocks. And therefore, we see the gamma squeeze, which is erratic, and it defies all kind of expectations. And we've seen this phenomenon before. The summer of 2020, right before the rotation, which we're going to revisit in a minute, but 2018, we've seen this phenomenon before. And the question becomes, if you look at the RSI, now it's reading overbought in contrast to October's oversold conditions. So are we about to see the shift from a mechanical market now that we got expiration date in options? Are we about to revert back to a technical market? And if we do, we have to follow the technicals. We're now overbought, which means we're going to see a sharp pullback. And the pullback is supposed to take us all the way back to the thinking range. In the meantime, as the market pulls back, it will be tested. Do we have more demand on buying? Do we have dip buyers waiting on the sidelines to pick up the market as it pulls back? Or are people going to be terrified a little bit that, yeah, hey, I told you this is going to get out of hand and it's going to go down big. No, I'm not buying anymore. Because if that's the predominant thinking outside, then we're going to see it going back to the thinking stage, in the reversion back to a technical market. And of course, the most important question is, when will it be a fundamental market again? Because when that happens, the mania ends, because the fundamentals don't support what's going on. But for now, we have no idea. We don't know when. But we know that the mechanical market is coming to an end. And we know that the technical market is about to follow. And this market says we're overbought, we're due for a pullback. You look at the deviation of the NASDAQ from the 200 days moving average, we're now getting to the territory where we've seen some big pullbacks in the past. You look at the S&P, it's doing a little better than the Qs. It's not really an outrageous deviation rating yet, which could support perhaps a rotation to the S&P and its components. So let's talk about it, and here it is. We know that the rally so far has been really consolidated in a handful of names. These handful of names, Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, Meta, now form about 25% of the entire US market when it comes to weighting. So whatever they do, they can cause a lot of distortions. If they rally alone, we could see the index actually rallying, even though the other 493 companies are either flat or down for the year. Likewise, when these names go down, the question becomes, what happens to the other companies? Are they going to start to rally? Or will it be enough to hold the indices? This distortion is causing, of course, valuations to go haywire. We will look at the S&P, the rest of the S&P. It's kind of average. It's supposed to be down in a recession year if we are anticipating a recession, but it is average right now. The so-called Big Seven that we just talked about right now, they are witnessing huge reinflation in valuations. The alleged fundamental case is AI, but for now, until we know what AI is going to do, it is just a multiple expansion rally. And among the distortions, we see the S&P 500 equal weight. It's up for the year, but it's up less than 5%, which happens to be a garden variety rebound after any years of decline. And last year, the market was down. We were expecting a rebound, and we have a mini rebound. It's less than 5%, nothing out of the ordinary. But then you plug the seven, the largest cap names in the world, and you see the S&P up almost 15% for the year, hence the distortion. And here it is. Even within the sevens, we see some distortions with Nvidia, Meta, Tesla out of whack, while we see Amazon, Apple, Alphabet, Microsoft lagging behind. And therefore, a lot of folks say we will see a rotation within a rotation, which is we see money coming out of Nvidia, Meta, Tesla, and buying Microsoft, Alphabet, Apple, Amazon. We'll see if that's going to happen or not. Yet another distortion born as a byproduct of the weighting of these seven names is the fact that Apple is now worth more than the entire Russell 2000. And the question now becomes, is Apple worth more than the Russell 2000 because Apple is in a bubble and it's about to go down? Or is Apple worth more than the Russell 2000 because the Russell was lagging for the year and now it's about to play catch up? This is a really important question. If the answer is the latter, then we're going to see a rotation, and that is healthy. That is a confirmation of a bull market. But if the answer is the former, that Apple got out of whack and it's about to go down, along with the Russell, then it is a confirmation that this rally was fake. Just another hype, and down we go. And of course, everybody's fixated on the Qs versus the IWM. Money has to come out of the Qs and chase the IWM. I understand why this is important. The reason is it serves as a confirmation of the beginning of a new bull market. And this is exactly what we saw back in 2020 and 21, when we got a successful rotation out of the Qs all the way to the Russell 2000 small caps, the IWM. But judging by the action that we got last week, and frankly speaking, the last couple of weeks, we have seen rotations, if you want to call them that, or at least buying interest in other sectors in the market besides the Qs and the IWM. And these are names we talked about in this show and Discord before. Names like Amgen, for example, up about 9.5% after an oversold reading. Deere, up over 18% after an oversold reading. You look at Duke Energy, for example, up over 6% after being oversold. Freeport-McMoRan, FCX, up over 23% after being oversold. In the last 2 weeks alone, Nike went higher by over 11% since being oversold. You look at Verizon, VZ, up over 8.5% since being oversold. You look at the XLP Staples, up almost 4% since being oversold. And then you look at the chart of Target, TGT. We played this one. Big rebound after being oversold. It goes higher by about 10% plus. And then on Friday, it pulls back. What happened here? Did we just see a bunch of oversold bounces? Or are we seeing a legitimate rotation? Well, the action from Target says it was not a legitimate rotation. It was a bunch of oversold bounces. This is really important to distinguish. Was the action that we saw in the last 2 weeks, even in the IWM, a mere oversold bounce? Or was it a legitimate rotation? We don't have the answer for that yet, but we're about to. And the answer will hold the key. Either we have a confirmation of the bull market or we have a confirmation to the rotation to the dumpster. Look at these sectors this week. The leader, sure, information technology, the AI mania, the usual suspects. But we also saw metals outperforming, industrials, staples, healthcare, utilities, financials, real estate. All sectors went positive this week. The exception is energy. And the question now becomes, are we going to see flows into the laggards year to date? We're talking about the staples, the healthcare, utilities, financials, real estate, energy, some of the consumer cyclicals, discretionaries. Are we going to see money flowing out of the winners, technology, communication services, into these losers and laggards? And these are not just the IWM, folks. Look at the Chinese market, the Hang Seng, laggard for the year, but maybe forming a reverse head and shoulder formation, and it's about to reverse a negative trend. And if it does, by the way, it indicates that the Chinese economy is indeed recovering. Maybe the stimulus is now having an impact. What did we talk about yesterday? Reinflation in commodities. If this recovers, it's going to happen hand in hand with commodities, which means more inflation. So what you have to watch for here to confirm any of these rotations happening, or maybe not happening, now that we have the Fed out of the way. If we see yields going down, I mean, the Fed paused, but they said, oh, we have 2 more coming, and then next year we're going to cut, and we're pausing, but we're not skipping, and we're skipping, but we're not, we don't know what we're doing. So we're still waiting for the digestion here. And if the conclusion is yields go down, and in this case we say yields going down for the bad reasons, we're supposed to see a rotation into high dividend stocks, healthcare, real estate, utilities, anything with high yields, anything defensive. If the dollar goes down, which seems to be the case right now if we go back to the video from last night, Fed pauses, ECB raises, along with the Bank of Canada, along with the RBA, then the dollar is supposed to go down. If it does, this will be good for China. You combine that with the stimulus, maybe the rotation should be in China, and this will include consumer staples. When the dollar goes down, the input cost goes down, yet they continue to charge more. So the margins are going to improve for these consumer staples companies. And the same can be said with commodities. We covered commodities in details. We presented the case for commodities reinflation yesterday. And if the dollar continues to go down, we see a recovery in China and in commodities, which means energy is going to benefit, which means industrials will benefit, which means materials will benefit, and the rotation should be in these sectors. Now, the problem with this, of course, is we're going to see reinflation in the economy, and the Fed will have to come back later on and end the party altogether. Now, we also have to look for yields going down, plus the prospects of soft landing, such as you have to look at retail sales, consumer spending, consumer debt, same-store retail activities. And if you start to see these things recovering, then the rotation should be in consumer cyclicals such as airlines, cruises, hotels, casinos, restaurants. It should be in the IWM, the small caps, the ultimate confirmation. It should be in regional banks, of course. Regional banks want to see yields going down, but also the prospects of consumer spending, of businesses asking for loans. They need to see a reignition in economic activities. And if that is the case, this will be good for retail stores too, the XRT. So you have multiple destinations here for the rotation, and you know what to look for now. If we start to see the dollar going down, or we start to see commodities recovering, and you start to see China recovering and picking up steam, then you know what's going on. We have a rotation into the weakness of the dollar, and we should be long China, staples, commodities, energy, industrials, and metals. If we see high dividend stocks catching a bid, and we go more defensive into gold, the healthcare names, the big pharma names, then you know we're following the pullback in yields. If we start to see the IWM catching a bid, along with regional banks, retail, consumer cyclicals, this is the kind of rotation that you actually should be hoping for if you happen to be bullish to the stock market, because it comes with confirmation. You're not going to see money chasing cyclicals, IWM, regional banks, retail, without conviction that this is the real deal. So this is what you should be watching for. And if it happens, it will be a good thing. And the ultimate test in the success of any rotation is what will be the reaction of these sectors we're supposed to rotate into. Once money comes out of the sectors we're supposed to rotate out of. We go back to the case of 2020. We have a rotation out of the NASDAQ, the Qs, the big caps, and we see a massive pullback. The NASDAQ went down by about 14%. But then you look at the rest of the market, the IWM, the S&P, energy. A lot of these sectors actually went down by a little bit, but recovered right away, as if nothing happened. That was the confirmation that money's coming out of the Qs. It takes a little while, and then rotates into the IWM, into energy, metals, etc., etc. That's the test. If we see money coming out of the Qs, and then the IWM, the S&P, regional banks, energy, dividend-paying names, all going down together, then we got a problem. Then we know that this is not a real rotation, and money's coming out of the market entirely. And with that, folks, moving on to the coverage of the stock market, we begin with the closing of the indices last Friday, and here we go. The Dow Jones was down by 108.94 points, or a decline of 0.32%. The Nasdaq was in the red, down by 93.25 points, or a decline of 0.68%. The S&P also down by 16.25 points, or a decline of 0.37%. Look at the sectors on Friday, all in the red, down, led by the names we're supposed to rotate out of: technology and communication services, but no rotation on Friday. The only sector catching a bid is utilities, and utilities happens to be defensive. So if we start to see days like this over and over and over again, grab the diapers, because the rotation is not happening, and it's supposed to happen. We look at the weekly performances. Here it is. Everything is up. Of course, you have the AI mania still working out, but we also have participation from the rotation sectors. Sure, tech is up number 1, but we have cyclicals at number 2. That could be due to Tesla, but we have metals at number 3. That's not really bad, 3% for the week. Industrials up also 3% for the week. Defensives up 2% for the week. Healthcare is up, real estate is up, financials up, but at some point for the rotation to be confirmed, we need to see technology, we need to see communication services actually go in red, and we start to see big upside days for metals, industrials, whatever sectors we're going to rotate to. We'll look at the breadth on Friday. NYSE 40% advancing versus 59% declining. The Nasdaq 38% advancing versus 59% declining. On to commodities, and it was a big week for commodities, mainly after the Fed. The 2 days after the Fed, massive gains across the board. We'll look at the month-to-date gains for commodities. Look at this. I mean, you got the Nasdaq up about 6% for the month, 6.5%, but it's being beaten by corn, cocoa, lumber, gasoline, lean hogs, heating oil, soybeans, canola, wheat, natural gas, oats, and soybean oil futures. What does that say? We're seeing rapid reinflation in commodities. Be careful what you wish for. On to options, the big casino. What do we see here? The volume all in all was at about average, a little elevated for Tesla. That is the exception, not the rule. Of course, now that we have options expiration upon us, it's already done. What happens? We see a lot of rolling. Now we're about to get new data in the morning. We're going to see where the rotation is actually happening. The leading indicator would be in rolling these options. If we start to see out of the money calls from last week on the Qs, for example, on the big cap technology stocks, not being rolled out, we got a problem. If we notice in industrials or in the IWM, we see out of the money calls rolled out, then we know where the rotation is happening. This will be the leading indicator. Then you look at the action on Friday, of course, the usual suspects at number 1, 2, and 3, Tesla, Nvidia, and Apple. And again, it's a bonanza of buying call options. Everybody wants to participate with minimal risk involved. So they buy call options. Now, what does that say about the conviction of the rally? If everybody's buying call options, not actual shares. Now the market maker has the power. They own the majority of shares. They control the destiny of this market. And that's not a good place to be. The destiny of the market should be owned by us, the investors, not by the market maker. And of course, the talk of the town last week was the VIX. When we look at the puts, those are the ones expired on Friday. Of course, a lot of folks say, Maverick, what happened to the VIX? It didn't pop higher. I would say this upcoming week has better outlook for the VIX than last week, because last week the bet was we're going to see a squeeze, but the squeeze required the VIX to go above 15 markedly, and it couldn't do that. But now we have all of these puts. Look at this, hundreds of thousands, I would say comfortably above a million contracts, all in the money, which means somebody has to buy the VIX. Huge quantities, and that's coming next week. We move on to the unusual activities that took place in the options market today, or I should say Friday. Today we're closed. How about VMW? And this is for VMware. Somebody sees the name moving higher, and they bought the 155 calls for the expiration date July 21st with expectations that the name will go higher and gain more than 9.5% by then. They paid about $2 a piece to enter this trade, all in all spending about $1.5 million. And of course, we have the EQT trades. This is really interesting. There's a million ways you can look at this trade. But in a nutshell, somebody sold a way out of the money call and way out of the money puts. And they used the proceeds to buy a closer to the money put. This could be a bearish trade. This could also be somebody who holds the stock, EQT, and they're using some de-risking strategies where the trader says, okay, I'm going to sell the covered call, 46, out of the money. The stock has to go up by more than 16% by the expiration date, September 15th. And I'm okay with selling the stock if it gets there. And then I'm selling the 33 puts, same expiration date, because I don't believe that EQT will be below 33 by the expiration date. But it might be under 37, so I'd like to sell the out-of-the-money call and the out-of-the-money puts and collect about $2 a piece. And then use this money to buy the 37 puts for the same expiration date, September 15th, in case EQT goes down by more than 6.5% by then. All in all, nothing is spent here. There are other ways we can look at this trade. I'll be happy to read your comments. If you can figure them out, let us know in the comments. There is at least 3 ways I can think about this trade. Let me know if you have any more. Moving on to the heat map analysis, we look at the daily heat map from Friday. Again, we see pullbacks, mostly in the winners, the big caps, software, chips, the exception being Tesla, of course. Tesla is still under a gamma squeeze, along with Nvidia, by the way. We see huge call options still showing up out of the money. But then we see some buying happening in big pharmaceutical companies. You look at AbbVie, you look at Bristol Myers, BMY. That chart is starting to look attractive, BMY, but not there yet. We'll look at the industrials, caught a little bit of a bid, although not the overbought names such as Caterpillar, FedEx, URI, Eaton, ETN, those were down. Some buying of utilities, real estate, energy, gold miners, NEM was up big on Friday. Then we see some buying in the defensives, Coca-Cola, Estée Lauder, Procter & Gamble all catching a bid on Friday. Not a major one, but some money's flowing in. We see Nike moving a little higher. But besides that, it was a low volume day. Some money came out, but not a lot of money went in. And this could be a problem if it continues, because we need money flowing into other sectors of the market. The problem here is if you're up 30% on Apple or Microsoft or Amazon, if you sell now, you're going to have to pay 50% for the big guy. So you have to hold for a year. If people decide to hold, then the rotation is not going to happen because money has to come out of something. If they do rotate, then money's going to come out of these winners. They're going to have to pay the 50% taxes. They're not going to do that, folks, unless there is massive and high conviction that the rotation is real. Otherwise, they're going to stick with the big caps. We're not going to see more buying. It's going to dry out. Some folks are going to book profits. Those who don't mind paying the big guy 50% in taxes, they're going to pull out. But put yourself in the shoes of somebody who bought, let's say, Tesla, Amazon. Forget about Amazon. Let's say Meta, Microsoft, Apple. NVIDIA, you'll be a little nervous. But Microsoft, Apple, Tesla, Meta, Google, sure. Let's say you're up big for the year in these names. Would you really sell right now, pay 50% in taxes, and chase any rotation at all in, banks? Why would you do that and take the risk? The risk of losing 50% of your profits and then losing more if the rotation turns out to be lousy. Why would you take the risk? And therefore I say, if they do it, it's going to happen from a place of high conviction, and you cannot fight that. But if it doesn't happen, and the thinking goes, you know what, let's stick with what we have right now. Why mess around and do rotations and all of that? Stick to Apple. It's working right now. If that's the predominant thinking, then the market will go down entirely because the sector is waiting for a rotation. They're not going to get that. It was an oversold bounce, and down we go. And money will have the net inflows versus outflows. Money will have to come out of the big caps because we always have short-term traders, short-term investors. They're going to book profits. And the question becomes, are we going to see more inflows into these names as they dip down? All of these things we have to watch for because these are the leading indicators for the success or failure of this rotation. We can spend another hour talking about this, folks, but we have to move on. Here's the weekly heat map. What do we see here? More of an inclusive rotation. The AI mania is playing out, of course. The NVIDIAs, the Microsofts, even Intel now. Even Intel is catching a bid, which is a clear sign of being irrational. Forget about the rally in NVIDIA. If you get a rally Intel, you're now in the irrational territory. But we see bids all over the place. We see bids in biotech, in big pharma names. Look at Amgen. Nice rebound finally. You got industrials up big across the board. Metals, defensives, Nike, even the Chinese names. A lot of inflows happening. But the inflows are going to dry out. And it depends on outflows from winners becoming inflows to the losers. Sustain this rotation. If that doesn't happen, then all what you see right now are oversold bounces and continuation of inflows into the AI mania. We'll look at the weekly heat map. For the ETFs, what do we see here? Again, much better breadth, but you look at the outperformance coming from large cap growth. Value came back, but the small caps did not really catch a bid for the week. You look at the KRE was down. You look at the commodities cohort, it is a mixed picture. XLE, XOP down. Then you look at natural gas, UNG, BOIL, they're up big for the week. We have a trader who bought call options on BOIL this week, made 3,000%. Really impressive. So if you look at this map and you think about the rotation as the IWM, you're sadly mistaken. What caught a bid this week? Chinese names, FXI, MCHI, and what comes with them. Not energy though, but metals were up. XME, XLB up big. Industrials, XLI, up big. Technology, chips, that moves higher based on the AI mania. But then you see more cyclicals also participating. XRT, retail, even the defensives, the yield-sensitive names. XLU, XLP, for staples, IYR, real estate, all catching a bid. So now we see bids all over the place. The question becomes, what will stick? This week, my hunch is it's commodities, it's China, it's the dollar weakness. What will it be this week and the week after that? I have no idea, but this is what we have to continue to watch for. Let's do some charts and then wrap it up. We begin with SPY, the S&P 500, 30 minutes chart. What do we see here? We talked about Max Pain on Friday, which was at around 440. That is the smallest win for the market maker, and they took that. They closed the market a little below 440. Is there a message here in closing below 440? The answer is maybe. Maybe the market maker wants to dump more in this upcoming week. And if they do, we have 438 and then we have 434. And that should be a stronger support. Of course, the SPY is also a leading indicator for the rotation. If it starts to outperform the Qs, and it holds better, then we have to watch out which sectors are they rotating to and why. If we plug in a trend line, you can see we had a false breakout in the aftermath of the FOMC, which got us all the way down to 434, closing the gap. But now it appears that we have an actual break of the trend, which means we should go down to 438. And if that doesn't work out, we go down to 434. We look at the E-mini futures daily chart. What do we see here? It looks like we're facing some resistance here, a stiff one, at 4,472. It appears that we have a reversal candle right now, known as a shooting star. Really close to, not a precise one, but close to. The bottom line is it closed at the lows of the day, and now we're awaiting confirmation. The confirmation would be a few red candles, or maybe one that breaks 4,384.5. You look at the RSI, way overbought now. The MACD is overbought too. So the S&P is primed for a pullback. What does that say about the rotation? Because the rotation is supposed to keep the SPY higher. Can we see a phenomenon where we see big outflows out of the big caps and technology, but also big inflows into energy, financials, metals, and all in all, we see the S&P down a little bit, but not as much as the Qs. That is a possible outcome, and it would be bullish, not bearish. But at the end of the day, if we believe that this was a mechanical rally, and we're now overbought, and the technical market is about to take over, then what it should do is erasing the entirety of the mechanical market. All of this move that we got due to mechanics and the stampede on buying call options, we should erase all of that. And that would take us all the way down to 4,300. You look at the weekly chart for the SPX, what do we see here? We closed within the range again. Is the SPX overbought on a weekly basis? The answer is not really, not yet. Could it pull back from here? That is a possibility, but it could also go higher because the RSI is not really that overbought. There's nothing we can do here. We have to watch whether the rotation is going to support the SPX or not. We look at the Qs, 30 minutes chart. What do we see here? We got the false break after the FOMC, got us down to 360.42. And on Friday, we got the real break. We talked about 370 as an important number for the market maker. Of course, the ideal closing was below 365, but the market maker ran out of time. And we're also seeing a lot of inflows for next week in certain names, Nvidia, Tesla, a lot of buying of call options here. But if this continues, we have support at 364.11. If that doesn't hold, then we have to go back to the FOMC low, which is 360.42. We look at the daily chart for the continuous contract for the Qs. What do we see here? Again, 15,500 is a little stiff. We have what it appears to be a rejection candle without a confirmation yet. The confirmation would be if we go down and lose 15,000 as support. And if we do, you look at the RSI overbought, you look at the MACD overextended, we need a pullback to erase the mechanical market move. That would take us all the way down to closing the gap, which will be a pullback of about 6.5%. And if we overshoot a little bit, we have the trend line all the way down at about 8.5%, could be 7.5% depending on when we get down to the trend line. Not if, but when. And then you're going to start to see these sentiment indicators cooling off. Now we're looking at 46 bullish. 47, some readings as high as 50 or even above 50. That's going to cool down if we go down, let's say 6.5 to 8.5% on the Qs. And then we'll see what happens. We'll see what kind of data we're going to get. We'll see what the Fed is going to do. We'll see what's going to happen to the rotation and then reassess. There is no need to chase. FOMO is for the dumb. It never worked before. Have you noticed that? It never worked before. It always ends in tears. Why can't you wait? Why do you have to chase? We look at the IWM small caps 30 minutes chart. What do we see here? We talked about 185 as an important number. Market maker got us all the way down there, but they did close above. Is there a message by the market maker that they want the IWM to move higher in the action we're about to get next week? Perhaps. But we need to see it getting out of the consolidation zone, which means IWM trading above 188, preferably above 190. We look at the daily chart. If we zoom out, look at 189. It is a stiff zone of resistance. And the question now becomes, when we talk about the rotation or lack thereof, it depends on this chart breaking out. It has to break above 189. You look at the momentum indicators, not looking pretty good. RSI weakening, MACD losing momentum. Friday's closing volume was a little too high. But of course, if you're bullish, you're going to look at this as it's a bull flag pattern. We're gathering the energy right now. The chart is asking for buyers. And soon enough, the buyers are going to show up. And if they do, higher we go. And that will be a technical confirmation of the rotation. You see how many indicators I gave you this show so far? From the dollar to macro to technicals. And the question is, are you paying attention or not? Are you taking notes or not? And then you say, oh, Maverick, you don't talk about the good stuff. You're always doom and gloom. I'm giving you a trove of information every single day. But most of you right now are jerking off to porn. I can't help you with that. Now the bears would look at this and say, it's really stiff, 189. You can't really pass above it. It's going to be a point of failure again. If that is the case, then down we go. So this is a battlefield right now. The success or failure is really important. We look at the Dixie. What do we see here in the 4 hours chart? We got a bounce from 102, but is it forming a bear flag pattern? And if it is, and we go down and break 102 as support, you know the deal. You're buying calls on commodities, you're buying calls on energy, you're buying calls on China, you're buying calls on gold, you're buying calls on metals. Use your head. Here's gold, not looking so good right now. And why not wait, folks? Wait for what, Maverick? You said wait for the Fed. The Fed is over. Wait for a break, you genius. Wait for 1928 to be broken, then you short, or wait for a break above 2000, then you buy. There's no need to make any rush decisions right now. Although, if you look at silver as a leading indicator, and I favor silver over gold right now, silver did pretty good on Friday. It's moving higher again. Is it too early? The answer is yes. But does it look better than gold? The answer is absolutely yes. And if the dollar breaks Dixie 102, we should be betting on SLV silver to go higher. You look at Brent oil, the daily chart, what do we have here? We now have a quadruple bottom, and 77 is a really important number. Sure, we closed below, but are we about to see commodities reinflation? The tailwinds are finally winning now, not just from the supply side and the Saudis, but from the demand side now, China refilling the SPR. If that is the case, higher we go. But we need to see a crack above 77. If you see Brent above 77 comfortably, you see the dollar down, you gotta pick up the dip in energy. We look at the daily chart for the 2-year yield. What do we see here? Above 4.5. Now we're looking at 4.75. I mean, at some point, something is gonna crack here. We go back to 5. See, this is the Grim Reaper right here. We can talk about rotations all we want. Or we can say, okay, now we have to go bullish China. Or now we have to buy metals. All of this is fun and games. But if this continues to go higher, and we see the next shoe dropping out of the blue, then we're going to talk about systemic risk again, and SVB was the appetizer. Now we have to deal with the main course. And if that's the point, when the Fed actually pivots and starts cutting rates, then we know historically when the Fed pivots and cuts rates, that is the moment when the market crashes and the recession begins. We look at 103, a daily chart. What do we see here? It moved all the way to 103.5 and then it failed. There's nothing we can do here. Leave it alone. The bond market is too volatile right now. We look at the VIX 4 hours chart. What do we see here? It slumped on Friday, lost 13.87, lost a lot of momentum. The question now becomes, was it a mechanical move on Friday, giving us the false sense of security? And now that we have all of these puts expiring in the money, we're going to see a gigantic amount of buying this week. And the rip in the VIX happens a week later than it's supposed to. The market loves to surprise, and therefore I did add to my volatility exposure. Now, if the VIX was trading at 25, 30, I would not do that, but the VIX trading at 13.5, the risk versus reward says you were on the right side here. When we look at Apple, the big kahuna, hourly chart, what do we see here? 185 exactly. Now, what happens? Is it going to stall and move down? That's the bet. We go down to 180, at least closing the gap. Then we have 177 and 175.38. And if you're going to play that, if you believe in a pullback in Apple, you got the lotto ticket play, which is buying the 180 puts, selling the 175 for the expiration date of this Friday. It's going to cost you about 20 cents a piece. Either you're going to hit big or miss. It's a lotto ticket. If you want more of a mature trade, you do the same thing. Buy 180 puts, sell the 175, but the expiration date should be July 21st. That'll cost you about $1 a piece. And by the way, this could be a hedging trade too. So if you own Apple and you want to protect from upcoming downside, maybe a little pullback, but you see it stopping at 175, this could be a good trade for you. We'll look at Tesla, daily chart. What do we see here? Stuck within a range now, 249.16 support, and then you got the gap. And some technicians would say that has been already filled in the pre-market session. I don't know how I feel about that. I'd rather see it in the regular session. Close the gap, then come down, cut through 249.16. Then we got a short in hand. And the immediate target would be pulling back to 234.86. And that would be a downside of about 10% from where the stock is trading right now. And believe it or not, this is not out of the ordinary. After a big mechanical rally like this, a pullback of 10% is nothing unusual at all. Now we'll look at some weekly charts for big cap technology stocks. We'll look at Amazon, close to the 129 target, and it did pull back by a little bit. Is it a reversal? The answer is not quite. We need to see a confirmation. But you look at the hour side, it is getting a little bit overextended here. Maybe not quite yet. Maybe it needs to go all the way up to 129 once again and then pull back. but we're getting really close. You look at Google weekly chart, not close to being overbought yet. We could see a pop all the way to 133.29. Then it becomes really, really overbought. Could it pull back from here? The answer is, it is a possibility. If the rest of big caps pull back, it will pull back from here. That'll be good enough for it. And the confirmation would be losing 117 on a weekly basis. We'll look at Meta. It stalled here while keeping support at 260, 259 actually. But you look at the weekly indicators, this is topping out. You don't want to buy it here. If you want to start shorting it, aim for August, September. And don't go too crazy to the 200 or 180 puts. You got to look at it step by step. You got 259, you got 244.61, then you got 230. I would not go below 230. We're betting for a pullback. We're not betting on a crash yet. You look at Microsoft, the weekly chart. What do we see here? Double top. Reached the target, overbought in the RSI, not quite the reversal candle yet, but we're getting close. The confirmation would be losing 320 as support. And then we have NVIDIA, an hourly chart. It did climb the wedge once again on Friday, but it failed after that. And this says that the stock doesn't have the energy, the demand to continue to go higher. They can buy call options all they want. That's not going to work anymore. Somebody has to buy the underlying shares. We know the insiders are dumping, and the outsiders, those waiting on the sidelines, they look at this and say, yeah, it's too high right now. I don't know how I feel about this. Now, if it loses 420 as support, we go down to 4.5, and maybe all the way to the ultimate destination of a pullback to 395.65. That would be a downside of about 7.5% from here. Will we see demand showing up? If we do, then it's going to hold. If we don't see demand, then that would be a warning signal that we're going to start to head toward closing the gap. Because there is no demand. Nobody's picking this up. The sellers are going to show if the buyers are not going to. And last but not least, what about tulips, Bitcoin, the daily chart? What do we see here? We talked about the wedge and the bullish breakout. We got it. Now it's consolidating at 26,555 as support or resistance, depending on what time of the day it is. But the bottom line is it's consolidating, looking for buyers. If the dollar continues to go down, is it really unreasonable to say that Bitcoin is going to catch a bid? The answer is not really. I might even buy it. You got to remember that Bitcoin has been the laggard. It has been doing nothing at all since the collapse of SVB. As if Bitcoin is saying, you know what? Now I'm acting as digital gold. I go higher when we have panics, when we have the dollar crashing along with yields. And I predict as Bitcoin, this is what Bitcoin is saying right now, I predict that we have a next shoe to drop. And that could be happening imminently. You look at rates close to 5% in the 2-year. If something breaks really soon and we see the dollar crashing, we might see Bitcoin catching a bid. We're just keeping an open mind here. The chart is not bullish yet. It has a long way to go. It has to go back to the consolidation range. It has to go on a retest to 29,200 as resistance. See how that works out. So it has a long way to prove that this is a bullish turnout. But we also have to examine the supporting fundamentals, mostly the dollar, and what's happening with systemic risk. Moving on to the conclusion of this video, what do we have on the economic calendar this week? Tuesday the 20th, meaning tomorrow, we have housing starts and we have New York Fed President John Williams. Wednesday the 21st, we have, here it is, the big dog again, Powell. And then we have the confirmation of another crooked governor, vice chair, whatever, Jefferson. Who cares? And then Thursday the 22nd, we have initial jobless claims along with existing home sales. Once again, Fed Chairman Powell, this time around in front of the Senate, and we have leading economic indicators. Friday, 23rd, we have services and manufacturing PMIs. And with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.